Welcome to the Explainer. Today, we're going to break down the exact visual anatomy of a seriously popular and honestly pretty powerful chart signal, the bullish engulfing pattern. But look, we aren't just going to stop at pattern recognition. We're also going to expose an incredibly dangerous trap that catches way too many beginners off guard. So if you've ever stared at a price chart and wondered what story those candles are actually trying to tell you, well, you are absolutely in the right place. Let's get into it. Here is our roadmap for today. First, we'll cover the core nature of the engulfing candle. Second, the strict rules for accurate identification. Third, the real significance of candle size. And finally, Section 1, candle, and that all-important shift in market control. You know, every single candle is basically a record of a financial tug-of-war. Just imagine it. On day one, sellers are entirely in the driver's seat. The price opens, it gets driven relentlessly down, and it closes near the absolute lows. Things look pretty bleak, right? But then, on day two, this massive counterattack happens. Buyers suddenly step in near those lows, completely reverse the momentum, and push the price all the way back up to close near the highs. And that's right there is a textbook bullish reversal pattern. It means the downward pressure hasn't just paused, it's been completely overwhelmed, literally engulfed, by a fresh, powerful wave of buyers. It's basically the market's way of visually showing you that sellers have run out of steam and buyers have just snatched the steering wheel. Moving right along to Section 2, accurate identification. Because recognizing the concept is great, but spotting it accurately on a live chart, that requires some strict rules. You really can't just eyeball this stuff and guess. You need precision. To accurately identify a true bullish engulfing pattern, three specific things have to happen. First, that second candle needs to open near the lows. Second, it has to close above the previous candle's open. And third, this is the crucial one, its physical body must completely eclipse or engulf the body of the previous candle. Now, what if that second candle's body is smaller than the first? Well, it's pretty simple. The pattern is entirely invalid. It is absolutely not an engulfing pattern. Sure, it might be a different kind of signal, but it's telling a totally different, way less decisive story about who controls the market. You really have to be ruthless with these visual definitions. Okay, Section 3. Let's talk about the significance of size and why it dictates market strength. Our source material doesn't mince words on this metric. The physical size of that engulfing candle directly represents the sheer volume of buying pressure. Put simply, the larger the pattern you observe, the more significant the reversal signal is. It's not just a binary yes or no kind of thing. It has real magnitude. Think about the psychology behind it for a second. A massive, sweeping shift in price from the absolute lows all the way to soaring new highs, that indicates a massive wave of buyer conviction. A tiny body might just be a brief pause in selling, but a huge, undeniable engulfing candle, that tells you deep-pocketed buyers have forcefully entered the arena. Which naturally leads us to the biggest question beginners ask when they finally spot this massive, highly significant signal. You see the pattern, it's huge, it perfectly meets all the strict criteria. So what now? Do you just buy immediately? Is it time to risk your hard-earned capital? The answer is an unequivocal no. Welcome to Section 4, no isolated trading. This is the reality check that truly separates the amateurs from the veterans. The trap lies in one specific, often overlooked detail. The buyers are momentarily in control, and things can change quickly. I really want to emphasize that word, momentarily. This pattern just means buyers controlled that specific, isolated time period. If you're on a daily chart, hey, they controlled that day. But market dynamics are incredibly fluid, and that control, it can flip right back to the sellers in a heartbeat. Here is the exact sequence that tends to absolutely destroy beginner accounts. Step 1, they spot this beautiful engulfing pattern. Step 2, they blindly go long without checking any other context. And step 3, they lose their money. Why? Because they are trading entirely without a true edge. A single candlestick, no matter how perfect it looks, does not give you a statistical edge on its own. So, the ultimate takeaway from today's explainer is this golden rule. Never, ever trade candlestick patterns in isolation. You have to use them exactly for what they are, a tool to help you understand the current, momentary representation of price and market psychology. Yes, it's a beautifully clear signal of a shift in power, but on its own, it is never enough data to justify taking a financial risk. So as you go back and analyze your own charts today, I want to leave you with this question to ponder. If this powerful, visually striking signal isn't enough on its own, what other market tools, things like trend direction, key support and resistance levels, or overall market structure, what else must you combine it with to finally uncover your true edge? Keep exploring, keep layering your knowledge, and I'll catch you in the next explainer. In this video, the visuals are used as illustrations to help you better understand the content. If you would like to explore the topic more deeply, feel free to join our community where you can learn new knowledge and exchange ideas with others who share the same passion.